Well, I think that's exactly right. That the last few years, we've really seen an unprecedented number of challenges and different environments coming through in a really fast space of time. So we've had obviously COVID, and then rising inflation, rising rates as a result of that, and then the banking crisis, and some geopolitical risk factors coming through as well. So we've had a series of very different market environments in a very short space of time. So it's been, we think, really important to take an active approach to manage through that. And I would say for two reasons. The first of all is to ensure that you stay invested. So avoid the risk of going into cash. And if you do that, then you give yourself increased timing risk. So by ensuring that you remain invested through those periods of volatility, you ensure that you can capture the full prospects of market returns. So the fourth quarter last year, for example, is a great example of that, in that if you had have been in cash, you would have missed a huge part of the rally that we saw in the fourth quarter last year in fixed income. And then the second is to be flexible, to be nimble in terms of the exposure that you take depending on the market environment. So we want to ensure that clients have the ability to selectively allocate between different parts of the credit market. So between investment grade, high yield, emerging markets, for example, again, to be able to navigate those changing dynamics in terms of the market environment that we're seeing, and build a portfolio that can deliver a balanced risk profile over time and a really good level of income. So we think the opportunity today in fixed income is really, really strong. So super attractive. We do have that combination of high yields today with, as you said, central banks that are either already cutting or are about to start their interest rate cutting cycles. So we've got this great combination of high income, and we think clients should look to capture that overall level of income with a longer term structural tailwind in terms of rates and duration driving that through. So again, we see great opportunities across the fixed income markets, whether that be in investment grade or in securitized. And what we can do is build a balanced portfolio that allocates across those different parts of the market that can deliver a really compelling level of yield to clients, but with a high credit rating profile. So balances that yield with the overall risk of the portfolio. And that, for clients, we think is a really important tool in terms of overall portfolio construction. So yes, fantastic time for clients to look to lock in that yield opportunity. So there are a huge number of elections globally this year, and so it does bring with it additional political risk, but also additional geopolitical risk around that. As depending on the outcome of those elections. But I think it's really hard to invest in a very binary fashion around that, because as we've seen already this year, the outcomes for those elections are often very unpredictable and often counter to what the general expectations may have been. So for us, the best way that we can approach that is to build a scenario-based approach to ensure that we understand the implications of the different outcomes of those elections, and then look to build portfolios that can benefit depending on the outcome of what the election may be. So from a risk-adjusted and balanced point of view, we can look at the sectors which we think may benefit. We can look at the overall longer-term trends in terms of policy or potential reforms coming through, and then focus on that over the long term and try and see through some of the shorter-term volatility or noise that election cycle can create. So we think emerging markets in general are a great tool to be able to use in broader portfolios, to bring in additional diversification, to bring in a different profile of returns, both in terms of the rates side of things, so looking at local currency and currency within that, but also more broadly, if you look across the full range of emerging markets, on both hard currency and local currency side of things. So really valuable levels of income, but also diversification that can offer. When it comes to politics and elections, again, it's a similar story, a similar theme, in that they can bring higher levels of uncertainty and definitely shorter-term volatility. But I think you have to be ready to be able to respond to that and to be able to invest tactically around that as opportunities do come through, depending on those election outcomes. So yes, maintain your longer-term thesis and ensure that you build your portfolio appropriately based on that long-term macro outlook. But have the ability to be more tactical to capture those opportunities as they come through, whether that be again, on the bond side or potentially on the currency side of things.
One.